Okay, hi everyone. Today is our sixth week of class, and we are going to discuss new lesson. And our lesson for today is all about financial ratios and liquidity ratios. So, financial ratios, but before that, let me first read to you our objectives of the day. So, at the end of this chapter, the students should be able to know the different liquidity ratios, solvency ratios, and profitability ratios. But today we are just going to discuss liquidity ratios. Second is to be able to compute the liquidity ratios, solvency ratios, and profitability ratios given a company's financial statements, and to be able to interpret the liquidity ratios, solvency ratios, and profitability ratios. So, financial ratios. So this is an analytical tool employing the ratio or proportion of a certain item in the financial statements or vice versa under related items in the same financial statement or other statements to determine a comparative performance. Second is, this is a financial ratio analysis. The item is the statement of financial position or statement of comprehensive income being evaluated or compared is assumed to have a direct relationship with other items in the statement. Next one is can be used to compare a company's current financial position and performance with those of past years and identify strengths and weaknesses. So in the process of using financial ratios to evaluate a company, ratios are often divided into four categories as follows. First one is the liquidity. So this is the ability of the company to settle its current obligations as they fall due. Second is the solvency. This is the ability of the company to settle its non-current or long-term obligations and the interest related to these obligations. Third is what we call the profitability. So this measures the company's operating performance as a return on its investment, and then it gauges management's efficiency in using company resources in order to generate revenue. The last one is what we call the market value or valuation. This measures the company's potential for future earnings, dividend payments, and stock price growth. So what I have told you a while ago, we will focus first on the liquidity. Here is liquidity. So this calculates the company's current or quick assets against its outstanding liabilities. And this is generally a high ratio indicates that the company has low risk of defaulting payment. So we have common types of liquidity ratios. The first is the current ratio. So this measures the ability of the business to pay its short-term obligations as they fall due, and it indicates the extent to which the current liabilities are covered by the current asset. So this is the most commonly used measure of short-term solvency because it serves as a single indicator of the extent to which the claims of short-term creditors are covered by the current assets. So here, the formula to compute the current ratio is as follows. So first is the current ratio is equal to the current assets over the current liabilities. So a current ratio that has declining trend may be an unfavorable indicator of the entity's liability. Such kind of trend may indicate that the business is not liquid or does not have the capacity to pay the currently maturing obligations. Here, we have here an example. The records of Vida's merchandising for two comparative periods are as follows. Or sorry, it's Yvonne merchandising. This one. So, you are just going to get, how are you going to get the current ratio? Again, by getting the current assets and then the current liabilities. So, our current asset is 665 pesos and 4 centavos, while our current liabilities is 620 pesos and 6 centavos. So the current ratio is 1 and 0.7 for 2016, and for 2017 the current assets is 725,000 pesos and 8 centavos, and The current liabilities is 551 pesos and 9 centavos. So the current ratio for 2017 is 1.32. So here is the analysis. So current ratio for 2016 is 1.07 to 1, while that 2017 is 1.32 to 1. So this means that for 2016, the company has 1 pesos and 7 centavos of current assets that can be converted to cash to pay every peso of current liability, while for 2017, the company has 1 peso and 32 cents of current assets to cover every peso of current liability that will fall due. Second is the current ratio of 2017 increased, signifying more liquidity for the company, although the company is satisfactorily liquid in 2016. And then analyzing the components of current assets for 2017, inventory and prepaid expenses for only 30% of the current assets. Hence, the 70% is cash and receivable, which can readily be used to pay short-term liabilities. Next is the quick ratio or the acid test ratio. So this is more stringent measure of the liquidity status of a business firm, since some current assets are not included in the computation. So inventories and prepaid expenses are excluded. So here, quick assets include only the following: the cash, the trading securities, and the trade receivables. So when you say trading securities and trade receivables, these are convertible easily to cash without reducing much the value of the assets. So the formula for quick assets is equal to cash plus trading securities plus the trade receivables. So the formula to compute a quick ratio or asset test ratio is quick ratio is equal to quick assets over the current liabilities. So quick ratio. So on our example a while ago, that our quick assets is, so the total for the cash, trading securities, and trade receivables are, for 2016 is 330 and 2 plus 172 and 1 over 620 and 6. So for 2016, we have 0.81 quick ratio, and for 2017, we have 0.92 quick ratio. So the quick ratio of Yvonne Merchandising is 0 and 81 to 1 for 2016 and 0 and 92 to 1 for 2017. So this means that for 2016, the company has 0 and 81 pesos of quick assets for every 1 peso of current liability, and 92 centavos for 2017. So being less than 1, we cannot immediately jump into the conclusion that the ratio is unfavorable. Next is the receivable turnover. So this measures the velocity of conversion of trade receivables into cash during the year and the efficiency of the collection effort. So the credit policy of the business, it answers the question, how many times during the year has a receivable been converted into cash? And then this is considered an asset management ratio, since it measures the effectiveness of the management in handling its resources. So here is the formula and how to compute the receivable turnover. So for receivable turnover, we have the net credit sales over average trade receivable. And for average trade receivable, this is computed as receivable trade receivable over receivable beginning plus receivable end, and then you are going to divide it by 2. So in computing the receivable turnover, the amount of receivable should be net of allowance for doubtful accounts. So in case data on net sales is not provided, so the data on gross sales may be used to compute the turnover. So receivable turnover for Yvonne Merchandising are 10.6 times and 9.74 times for 2016 and 17. So respectively. So this means that the company was able to collect its average receivables. So 10.6 times in 2016 and 9.74 times in 2017. Next is what we call, or what we have, the average collection period. So otherwise, this is called as days sales outstanding. So this is the approximate number of days it takes a business to collect its receivable from credit or account sales. Next, so average collection period has two formulas. So the first one is the average collection period over is equal to 360 days over trade receivable turnover. Okay, so for average collection period, we have average receivables over average daily sales, and also we have the annual sales over 360 days. So the average collection period for 2016 and 2017 are 34 days and 37 days respectively. So the determination whether 34 days and 37 days are favorable depends on the credit terms extended by the Yvonne Merchandising to its account customers. So if the company's term of credit is 30 days, then the average collection period for both years is not favorable since it exceeds the 30-day credit term. So for inventory turnover, the ratio measures the number of times inventories are acquired and sold during the year. So the inventory turnover varies from one industry to another. So the nature of business and the type of goods or the consumer or industrial are factors that must be considered in evaluating and inventory turnover. So the inventory or turnover is computed using the formula inventory turnover is equal to cost of goods sold over the average inventory. So average inventory is computed as inventory beginning plus inventory end divided by 2. So for average sales period, so this is known as the inventory conversion period. So it is the time to convert inventory to sales. So the formula for this is average sales period is equal to 360 days over inventory turnover. And then for the last one, we have the working capital. So this measures the short-term liquidity of a company. So the formula for working capital is equal to the current assets minus the current liabilities. So we have here the example. Okay, so that's it for our lesson for today. And please answer the activity given on your LMS. And that could be all. Thank you and goodbye.